editor, the governor of the South African Reserve Bank, along with his team from that tall, lonely, and also odd-looking building in the center of Pretoria, the Reserve Bank, in tandem with targeting rates, with your colleagues, the water cooler at the water cooler.
Well, good morning. We do Microsoft Teams. We have tea on Microsoft Teams.
Tea.
I have not been inside that tall building for more than 2 months now. I've been working from where you see me now.
Yeah. I mean, seeing how you've managed to lead the bank that oversees one of the most liquid currencies in the world, the rand, from home for the past 2 months, what does this say about just, the future of banking in general? I mean, these branch networks that were already shrinking, not only number but size, likely to increase even further.
Well, I don't know when you were last inside a bank. My bank branch is very far. It's in Johannesburg, and I'm not about to drive there. And my cell phone had become very handy. That's where banking is taking place. And I think that the one thing about this COVID crisis is that it had begun to, people are beginning to ask the questions, why do we need all of those offices? Or maybe should I tease you and say, why do you need a studio if you can interview me from where you are now?
That's true. This is a whole change. I mean, this is the thing about COVID-19, right? It does seem to like fast forward history in a way, which is the ultimate test for policymakers. We need to worry about the economy, job security. I mean, you were at Treasury as a young man, I think during the 1997, 98 Asian currency.
I'm still young.
Still young, yeah. No, I didn't. It's relative, I guess. You were at the Treasury as a young man during 97, 98 Asian currency crisis, the 2001 dot-com bust, and the 2008 global recession. Do any of those crises compare to the almost transformational nature of COVID-19?
Look, firstly, this is a health crisis, and it has created for us an economic crisis last seen in a century for South Africa. I mean, just checking the figures, I think the last time we had the economy contract 2 years in a row by just over 6% was 1930 and 1931 in the aftermath of the global, the Great Depression. So our own forecast as the central bank this year is for a contraction of 7%. And policy making in this environment becomes really complex. Part of it is that just as all of us are either working from home and we have shut down offices and so forth, so has SA. And they are having to make special adjustments and so forth. So you are almost making policy in the dark, because policy is based on evidence, and evidence comes from statistics. And so we, from where we are, we have had to postpone our June quarterly bulletin. It will only come out in July. Statistics South Africa, the April CPI figure will now only come out in June. And we have had, there are things that we would have to reconcile with Stats SA in order to finalize the quarterly bulletin. But clearly Stats SA is going to have to make certain adjustments. Some of the companies that they have to survey were closed. So how do you do that? There are statistical techniques that they would have to use to make certain adjustments to the data so that they can give us figures that are credible.
Now, speaking about more the short-term crisis in the country, on Monday, just this Monday, after loads of pressure on the president and his cabinet, I think some 8 million people are joining the 1.5 million that are back to work to grease the wheels of the economy. Now, I've been rather uncomfortable about this insensitive nature of the debate around the health of South Africans versus that of the economy. I'm releasing workers into, and as I start about winter, on Monday. Just when COVID-19 is the preferred environment by all accounts for COVID-19, how concerned should we be about this next stage in the recovery of South Africa?
Well, first, as I said, that this is a health crisis, and it's about people, and it's about people's lives. And when we went into lockdown, the president communicated quite clearly that we are about saving human life. And I think that is a false dichotomy to say, do we choose life or do we choose the economy? It's a false dichotomy, because the economy is about people. It's about people, it's about their needs and their wants, and it's about their desires. The world over, countries did go into lockdown, and countries are reopening. Some had opened faster than others, and some of them had made mistakes. And I've got no doubt that at some point we will also find that maybe we have made this or that mistake. But the issue here is about managing the risks, and the government really coming out and saying that we are going to reopen the economy on a risk-based approach. It's absolutely the correct route to take. But that is what everybody around the world is grappling with. And what it does is that it places a lot of responsibility to us as citizens, because during the lockdown, government has to be enforcing particular behavior. And as you reopen the economy on a risk-based approach, there is more responsibility being placed on us as citizens to continue to practice social distancing, to practice correct hygiene, and all of those things. So the fact that the economy is reopening does not mean that we try to go back to the way in which we lived before before COVID hit our shores. That just places a lot of responsibility on us as citizens.
I've been reading a lot about the world economic thinking before the 1929 stock market crash. I guess I've had to go there because everyone has almost equated what's happening now in the world to that crash and subsequent Great Depression. I mean, the success of governments before that crisis, before 1930 wasn't necessarily judged on ensuring that it's growth at all costs, but more on ensuring stability of the economy. I mean, the growth has been the yardstick by which we've judged governments since the end of maybe World War, as far back as World War II. But maybe, I don't know if I should be a business journalist, but how feasible is it that the world continues down this path and looking after its people at the same time?
Well, every crisis changes the way we live. It changes the way we see life, the way we see the economy, and so forth. And I think that the manner in which we're going to have to measure our success coming out of this crisis, we've got to understand the nature of this crisis. I've spelled out earlier that it is first and foremost a health crisis, and it was thus correct that the first response had to come from the health authorities, and our response was a health response to this crisis. That is the first point. Secondly, is that this health crisis actually led to an economic shock. And what has been the nature of this economic shock that we face? The nature of the economic shock had been both of a supply and of a demand nature. Firstly, supply form in the sense that we had the disruption of global supply chains, and in our response to the virus, we ended up having to go into lockdown. And as we got into lockdown, we also thus induced domestic supply shocks, and it had to happen. It has been a demand shock now as well, because the nature, the manner in which people had to deal with this crisis, people experienced a decline in income. Some of the people had to be experiencing a situation where they had no income at all. And so if people do not have money to spend, then that brings in a demand shock to the economy. And fourthly, is that this has also been a financial portfolio shock. Global financing conditions tightened. Capital started to flow out of emerging markets to the safe haven of the US dollar, and that just meant that the manner in which we're going to respond, you're going to have to respond to all of these shocks at the same time. Now, from where I'm sitting as a central banker, the thing was a very clear one. If you are faced with a demand shock, monetary policy has got a lot of space to deal with a demand shock. You provide relief to businesses and firms, and by so doing, then you spare a demand. If it is a supply shock, there isn't much a central bank can do, which is why you needed fiscal policy to respond on the other hand, and you also then have to take other economic measures. Now, what did we see in the South African side? The financial shock manifested itself in different ways in the South African economy. Firstly, at the beginning of March, prior to the downgrade by Moody's, by the way, we were seeing tensions within the South African financial market space. There was a dislocation in the South African financial markets. The government bond market was almost becoming dysfunctional. And so it was very clear for us as a central bank that we are going to have to do something about the financial markets. Why? It's not because we just like financial markets. It is because the manner in which our own repo system works is that it works through the collateral system that is priced in the bond market. Government itself runs auctions every week, and it is priced off the same bond market. And if it is dysfunctional, that means that the price at which government would be borrowing would not be reflective of the genuine supply and demand of funds in the South African financial market. And so from the central bank perspective, we provided relief through monetary policy. We embarked on bond purchases to get the financial markets to continue to work. Thirdly, we provided regulatory relief to the financial sector so that credit can continue to flow to businesses and households. And more importantly was that as the financial sector itself provided relief to households through either payment holidays or rescheduling of loan repayments, that meant that they themselves would have to dig into their capital and into their liquidity, and that is exactly the kind of relief that the central bank provided so that the economy continues to be on.
I mean, in the past, they may have called our Reserve Bank conservative in nature, but with those measures, are we nearing a point where there's very little else that conventional monetary policy can do to, I guess, to stimulate the South African economy, or just how much more space is there for the Reserve Bank to act with regards to the South African economy?
Conservative is not quite how you would describe the South African Reserve Bank. Prudent, yes. If you say we have always been prudent, yes, we have always been prudent. Do we believe that the steps that we have taken have been measured and are prudent? Yes, we believe we have. Do we have space to do other things in the future? Yes, we would be able to continue to deploy our tools to support the South African economy And we are able to do this in accordance with our mandate, and we deploy these tools as we deem appropriate. And that appropriateness is where prudence actually comes in. Have we come to the point where conventional monetary policy is not effective? Not yet in our case. Many advanced economies have reached the point where what you had called conventional tools had ceased to be effective, but many of the tools that they believed were extraordinary have almost now become part of their toolkit. But we are not there yet, and we have got the room, and part of it with building buffers is exactly that you are able to utilize these buffers when you are faced with a crisis. And I know, I mean, people talk about bond purchases as unconventional. There is nothing unconventional about it. We have always done open market operations, buying and selling bonds in order to have an impact on domestic liquidity. There is nothing unconventional about that. It's just that it had not been used for such a long time in so many other jurisdictions that people look at this and says, oh, this had not been done before. But there is no doubt that as you face with a crisis, as you deploy your tools, you may find that you have to refine your tools. It might even be that you must find additional tools that you would deploy in order to respond to a crisis, because every crisis is different. And earlier in your intro, you were painting these other crises that we lived through as South Africans, from the 1998 crisis, and that crisis was emanating in the financial sector. And in 2001, we had the Argentinian default. In 2001, you also had the dot-com bubble. 2007, 2008, you had the great financial crisis. You learn from all of those crises, but none of those crises can be even compared to this one in terms of its impact on human life that we have seen.
I mean, I want to go back to a bit about the criticism that's often leveled at the Reserve Bank of the conservative nature, or would you call it prudent? I mean, how do you feel about the criticism? Or I always feel, in terms of for emerging market central bankers, a lot of your world is limited or shaped by what the U.S. Central Bank, the Federal Reserve, does. It seemingly does almost put you in. You almost have to react in some sense to what the Fed does, or with its policy, given that they are the custodian of the world's reserve currency. What's your take on that, and just how you have to balance the decisions you make here down south with what is happening in Washington, for example?
Well, you know, we are a small open economy. And as a small open economy, as you deploy your policy tools, you have got to be cognizant of what is happening with the global economy, because we are interrelated with, interlinked with the rest of the world. We import from the rest of the world, we export to the rest of the world. We attract foreign savings to fund our investment, and our own companies themselves make outward investments, whether it is to the African continent or elsewhere. That happens. Now, how does what happens in the US affect us? I mean, the US is a big economy. It constitutes just over about 25%, maybe slightly more of the global economy. It's a significant amount. So very clearly, what happens there would have an impact on what we do. How do we think? About it? We actually take a weighted approach. The way in which we think of the global economy impacting on us, we take a weighted approach. And so we would say, what is the weighting of the US economy relative to that of South Africa? What is Europe? What is Asia? And so forth. And so what we end up doing is going to end up having to take account of developments in what we would then call the G3 economies. And so you interact with them on that basis. But Ron, taking account of what is happening there is not tantamount to doing what those countries are doing. So, you know, the Jamaicans had this saying of monkey see, monkey do, you know, which basically means that you try to mimic what the others are doing. We can't do that and say the US is embarked on quantitative easing, therefore we must do it. Or the ECB has done quantitative easing, therefore we must do it. We must say, under what are the circumstances they face and what are the circumstances we face. And so there is a limit to what we do, even as we are embarked on bond purchasing to get our financial markets to work, which is that we purchase government bonds, which means that we are injecting rent into the economy. That rent must find a way somewhere. And you know what? The point here is that the Fed is doing the same thing, buying bonds and putting dollars into the market. And guess what? As they put dollars in the market, everybody in the world is trying to buy dollars. They are all running to the dollar.
Yeah.
Now, think of us. As we are putting rent into the market, is it that everybody in the world is looking at buying rent? No, they are not. Why are they not doing so? We are not a reserve currency. So there are limits to what we can do in terms of injecting liquidity into the system. And it would not take long as you inject liquidity into the system. If you are not doing it in a prudent manner, you will end up with a situation where the injection of liquidity will find itself into the foreign exchange market, which could lead to the exchange rate reacting. And if the exchange rate begins to weaken, that could actually then feed itself eventually somehow back into inflation. It has not happened so far.
Yeah.
Why has it not happened? That must be testimony that the steps that we had been taken prudently and not recklessly. And if we had done them recklessly, you would have seen this thing manifest itself in the weakness of the currency. The currency did weaken, but it was not because of the actions we had taken. It is because of the nature of the shocks that I had talked about. But even with the depreciation of the currency, we have not seen inflation surging up. Inflation remained contained. Why? Because there was another shock which came through the oil price. Since we are an importer of crude oil, the crude oil price actually collapsed. And so the decline in the oil price more than compensated for the weakening of the currency. And that is what provided us with the scope, and that is why you saw inflation even going forward being contained. And so for the next 12 months, inflation is not a big problem for us in South Africa. Would it continue to be like that? We don't know, but we cannot behave as if inflation will always be what we have experienced this year in the midst of this shock. And it is important that as the central bank, we try to look forward, look 12 to 18 months ahead. And as I have said, in this environment of uncertainty, it becomes tricky. It becomes really difficult because, as I have said, data is scarce, you are looking for evidence and so forth. We do not know whether we would have a next wave of infections, and if we have the next wave of infections, what's going to be the reaction function of the health authorities and so forth. All of those moving parts are all complex, and it just makes our job difficult, which then means that as we deploy our tools, we have got to be alive of potentially what the risks are and make sure that the tools are deployed in a manner that is prudent and thus manages the future risks that the South African economy could actually face.
Which goes well into my next question for you. I've just had an interview with 91's global strategist, Michael Power, and his critical take on inflation targeting, was introduced at towards the end of the 90s. I'm sure you were part of those debates. What's your views now on the strengths and weaknesses of inflation targeting, especially when, as you say, for the next year at least, there's no inflation threat in the South African economy?
Well, Ron, inflation targeting is a kind of monetary policy framework. There are other frameworks out there, and believe me, we in South Africa we have tried 2 of those before with disaster. There used to be a time when we targeted money tariff aggregates, and we said that if money supply grows at this pace and credit at this pace and this and so forth, then inflation will be at this level. So target those, and that framework eventually got abandoned. And the former governor of the bank, Governor Stiles, the 7th governor of the Reserve Bank, when asked, why did you abandon monetary aggregates? He says, no, we didn't. The money aggregates abandoned us. And that was because the framework was no longer fit for purpose. And in the 90s, we embarked on something in South Africa called an eclectic approach to monetary policy. We tried to look at everything. And within there was a subtlety that we are actually targeting the exchange rate. We ended up running massive net open forward oversold position, which cost South Africans billions of rands, and the central bank came out second best. So that didn't work. And that's when we embarked on a framework of inflation targeting. Now, interestingly, is that next year will be 21 years of inflation targeting in South Africa. This year, because we have had inflation targeting for 20 years. And we've got to be able to look back and say, how well has it served us? And compare the era of inflation targeting to the era prior to it. And what we do know is that prior to inflation targeting, growth was volatile and even lower. Inflation was higher. And in the era of inflation targeting, not only did we manage to get inflation contained, we actually experienced higher growth until the global financial crisis actually set in. And so the inflation targeting framework served us well. And now as we are looking at it now, Ron, if we didn't have an inflation targeting framework, people would be asking about exactly where would the Reserve Bank contain inflation. It could easily, you could have ended up with de-anchored inflation expectations. But what we have actually seen is that through our action and our communication from around 2017, we communicated that we would like to see inflation expectations anchored closer to the midpoint of our inflation targeting range. And we have succeeded. We have succeeded in that. And guess what? It is precisely that we came into this crisis with inflation around the midpoint and just below the midpoint that provided us with the space to provide monetary stimulus. Because all the actors know that we would like to see inflation closer to the 4.5, and they know as we provide the stimulus, given that we are a prudent central bank, that we would do so in a manner such that it does not lead to inflation running away from what we have actually been tasked with, which is to keep it within the target range of 3 to 6. And so, having been at the midpoint and slightly below the midpoint, provided us with the space. If we experience a shock and inflation begins to rise, we still have the flexibility within the target. And that is where the flexibility comes in. Now, in all of those other frameworks that I had described, give me any central bank worth its salt. Any central bank worth its salt, if it does not care about inflation and what it does to the buying power of working people, on that central bank is not worth its salt. For people with assets, financial assets and fixed assets, when inflation rises, somehow they can protect themselves against inflation. Property prices go up because inflation is going up and all of that stuff. They can be protected against inflation. If you are on a fixed salary, you might be lucky and be able to negotiate with your boss a salary increase once a year. But if inflation keeps rising during the year, I don't think you would be able to go back to your employer during the year or every second month and say, I need another raise because inflation has gone up. What that would mean is that the buying power of your salary will decline. And it could have been worse. You could have been a social grant recipient. And as a social grant recipient, you cannot negotiate your increase. You take what government has given you. And as inflation rises, the value of your social grant erodes. And that social grant buys fewer and fewer goods and services. So for me, the task of containing inflation is about the welfare of a nation. So if you care about the welfare of the South African society, you would not be advocating for inflation to be allowed to run amok. Fortunately, as it is now, there is no risk of inflation running amok, which is exactly what has provided us with the space to provide relief and support to households and firms.
Now, going to, I think we spoke about this a bit earlier, but it is in the news flow, it is in the political realm, the quantitative easing experiment. I mean, which was basically a process where a central bank buys government bonds and quite literally pumps money into the financial system. It was made popular. Ben Bernanke, the former US federal governor, in his salvation mission of the US economy 10 years ago, and in turn, the global economy. And that's, I mean, politicians here and globally, I guess, are rather, and I always thought they get excited by it, or excited by the prospect of using it whenever there's a crisis, save the economies. QE is the way to go. In a South African setting, just to make it clearer for those who will still push for it, just what's your take on QE within our setting?
QE is a tool that is available to central banks. Like all the tools available for central banks, you deploy tools at a particular point in time if the conditions are conducive for the deployment of those tools. To make this point, what you had when QE was deployed in the developed economies was that the developed economies were facing a particular problem. The problem they were facing was that inflation was collapsing. And in some instances, even threatening to go below zero. In the case of Japan, it did go negative, by the way. And, you know, the Japanese had done QE long before the US could even think that it is conceivable for them to do QE, because Japan was facing deflation. They had to fight deflation. And deflation is as bad as inflation, if not worse than inflation. Because think of it, Ron. If today you are going to be buying a phone, and the phone is 1,000 rands, for argument's sake, if you know that you are facing deflation, and that if you wait just one more month, this phone will be 900 rands, why would you buy the phone today? You will wait to buy it in a month. And once you get to that month, if you think that it might decline to 800 rand or 700 rand, you might want to wait even more. And what then that happens is that the producers will stop producing, and then you go into that downward spiral. And so many of those advanced economies were faced with that kind of a situation that they've got to avoid that. Something that we've got to avoid, the Japanization of our economies. So they had to fight deflation. Now, Ron, before they even got there, they cut interest rates to the point where the interest rates were like 0.25%, 0.5% in some instances. To the point where interest rates didn't matter for borrowers and savers. And economists complicate these things. We call it the zero lower bound. Okay? But think of it. Even as those countries were having interest rates at almost zero, money continued to flow there because those countries have reserve currencies. Yeah. Let's think of it in South Africa. Our inflation is not zero. We've got the scope. Our interest rates are not zero. And they do not have to be zero. But contemporaneously, if you look at what the policy rate is now at 3.75 and where inflation is expected, you'll see that we are running real interest rates, which is the difference between the interest rates and nominal interest rates and inflation of almost zero, sometimes mildly negative. If you look at that over the next 12 months, where we expect inflation to creep up back to about 4%, that means that we are having negative real rates. What that means is that irrespective of when you put your money in the bank, your money is earning less than what expected inflation is going to be. Now, this can also be deployed. And there were times in 2011, 12, where we had negative real interest rate because the environment was such that we could, because of what we were facing with the economy. That's what we are faced with now. We have got mildly negative real interest rate. We have got the policy room to maneuver. So QE is not appropriate for South Africa at this stage. It is a tool that we have. Should we be faced with a situation where we think South Africa is facing deflationary conditions and we would have to deploy that to re-inflate the economy, it is a tool that is available for us to use. It is just not appropriate at this point in time. And even if we are to embark on it, we must just be cognizant that we have got a constraint that the US, the UK, Europe, and Japan does not have. And that constraint is, ours is not a reserve currency. And this is sometimes what worries me, Ron. You know, when Ben Bernanke was talking about preventing deflation in the US. He talked like he would deploy helicopter money. It will not happen in the US. And people in South Africa, you hear some people even talking of helicopter money in South Africa. And I say, are you sure you are not talking about the US economy? Because I can tell you now that for the South African economy, if you were to deploy that now, you will see that money actually manifesting itself, not just in inflation, because we are faced with inflation, but you will also see it manifest itself in the exchange rate. And so if people think that you could just print money, then we would have no country that is poor. Because think of it, why would countries be poor? Because they will just print money and then, boom, problem solved. But guess what? There are countries that have just done it, just north of the Limpopo here. There is a country that did just that, and the consequences are there for everyone to see. The history of Latin America is loaded with examples like those. And you can go on, Uganda under Idi Amin did the same thing. He even asked, have you run out of ink? Why don't you print more money? In this environment where we are faced with a response to this COVID crisis, there are a lot of emerging macroeconomists who seem to have graduated from the universities of social media, who are coming with ideas which, quite frankly, face with the conditions that we have, are not viable propositions.
So let's talk about the measures you've taken over the past 2 months of the interest rate cuts and the like, which you've done about borrowing costs and banks and freeing up space for banks to lend to entrepreneurs and so on. I mean, in the country, where only a small percentage of South Africans, I guess I include myself here, are exposed to interest rates at all through either mortgages or car payments. Just how much do you think these cuts will actually feed into stimulating the economy? How effective are they generally, just given the makeup of the South African economy? Like just our historical, it is what it is, as the common term is.
Look, let's be clear. I've noticed that I've not used the term monetary stimulus. I've used the term monetary relief.
Relief.
And
okay.
and consciously so.
Yeah.
Because Ron, when you cut interest rates, the nature of the transmission mechanism is that the people who immediately benefit are the ones who are currently having debt. So those people with mortgages, car loans, personal loans, credit cards, those people feel that relief immediately because their debt service costs go down. And to the extent their debt service costs go down, and we take it that they are rational beings, that gives them the space to go spend that money. And if you give them the space to go spend that money, then it is supposed to lead to more goods being produced, because that is the way, theoretically, how this transmission mechanism should work. If you are an entrepreneur who was looking at starting a business, the lower interest rates would mean that your hurdle rates have gone down. And so you could benefit from that. If you are unemployed or are just a recipient of a social grant, you will not feel the reduction in interest rates. Now, we have had to make an estimate of the impact of this. And in peacetime, you would say that a cut of, say, 100 basis points could inject up to 32 billion rands into the economy via the borrowers. We have done 275 basis points since January this year. Do I think that those metrics still hold? Well, those metrics would not hold for the period that you had the economy under lockdown, because you are stimulating demand, but as you stimulate demand, supply is unable to respond because the factories are closed. So you will only really feel the impact of these interest rate cuts as the economy reopens and economic activity returns. As we do this thing, as the government had said, reopening the economy on a risk-based approach. That is when you will have that feeling. Of course, there is the other steps that we had taken, which we had to do with government bond purchases. They have stabilized the financial markets. I would not like to believe that they are solely responsible for the decline in bond yields, but bond yields are now at the level they were before the Moody's downgrade. For a bond market that is trillions of rands, modest purchases of a few billion rands by the central bank, really all that we had done was to facilitate price discovery rather than make a big impact on the bond yields. But government did benefit from that because government is now able to borrow cheaper than they were earlier in the year, especially if they are borrowing in the short end of the yield curve. If they are borrowing 3 months, 6 months money up to 5 years, those rates are lower than what they were in January. So government does benefit, and if government benefits, those benefits are supposed to filter through to all of us. And I think that probably gave government also the space to provide the relief that it had actually provided. And thirdly, of course, was this scheme launched by the Treasury, the loan guarantee scheme. We facilitate that in the sense that we are providing liquidity to the banks, but it is really a scheme of the national Treasury. It's guaranteed by the national Treasury. And even there was providing relief to existing businesses to be able to meet their needs, cash flow needs for the next 6 months. So it still boils down to what I was saying to you, that when you make adjustments on interest rates, the people who get the immediate benefit is always the borrowers. And lastly is that, of course, when these things happen, I always get an odd letter from a disgruntled pensioner who says that, do you realize what you have just done? My pension, I have a pension, I invest it, and I live on interest. And you have now cut the interest rate, which means that my income has actually declined. But that is what you are faced with. The interest rate, policy rate is supposed to equilibrate the demand and supply for savings.
Finance Minister Tito Mboweni recently, I think when we were at the height of this crisis, when everyone was just like in sheer panic mode, I think around this crisis, was said at that time in a press conference, he was speaking to you about 4 times a day. I mean, this coordination between yourself and the Treasury, does it not blur the lines somewhat between monetary and fiscal policy? I mean, you've been a staunch defender of the independence of the Reserve Bank. Just give us between this blurring. Sometimes, I know internationally, it looks very clear that there is this blur between monetary and fiscal policy. What's your take on that?
Well, I thought that I was a staunch defender of central bank independence. I want to tell you, if you thought I am, you must check Tito Mboweni. Tito Mboweni is the most fiercest defender of central bank independence. And in the interactions that I would have with him, and I say, I am telling this is the things that we do, is that you always remember you are a central banker. You must stay in your lane. And that counsel from a minister of finance that says, remember, you are a central banker, stay in your lane, is exactly what you need to have an effective coordination of fiscal and monetary policy. You must know that the coordination of fiscal and monetary policy settings does not mean that one encroaches on the other. It just means that do we have a trajectory of what the macroeconomic stance is of the country? And once you have got the trajectory of what the macroeconomic stance is, let each one of those two authorities deploy the tools at their disposal to deliver on the macroeconomic stance that we are actually looking for. Now, I mean, I speak to Tito Mboweni sometimes 3-4 times a day, and sometimes it's not even about politics. I am feeling down and I need to talk to somebody who would provide counsel on how I think about this economy. What do you see in the economy? And it is just useful to have that kind of thing. That said, these consultations between the Minister of Finance and the central bank are not just a nice to have. It is actually a constitutional injunction. The Constitution says that there must be regular consultation between the central bank and the cabinet, national cabinet member responsible for national financial matters. And that is the Minister of Finance. And in that interaction, it's always important that everyone stays in their lane. So you will find that I will not pronounce about fiscal policy. Tempting as it is, I mean, I've spent 15.5 years in Treasury. I have got strong views on what the fiscals should be doing and what tools should be deployed and all of those things. Well, that is what I was responsible for 15.5 years, but no more. So I choose not to talk about fiscal policy, and I would talk about monetary policy and how monetary policy contributes to the macroeconomic stance of the country and to the trajectory of the economy. More importantly is that you must understand that monetary policy's responsibility of price stability is in the interest of the welfare of the citizens of this country.
Now, I guess this will shape how I phrase the next, and probably closer to the final question to you, is to the South African economy. Now, as you've said, you've been associated with the country's fiscal and monetary policy in some shape and form, I think since 1996. It's 24 odd years, still a young man, but the past decade being the roughest, leaving us with little buffers for our current crisis. Now, as we look at the next decade ahead, without you going too in-depth with fiscal policy at all, but just giving you experience, how, and as the dangers ahead for the South African economy, if we do not think through this crisis well and emerge stronger, and almost, I really do think we need to reimagine the economy, but what dangers does the South African economy face in the next decade, given just what this crisis has brought us to?
It's difficult enough to predict what's going to be happening in the next few months, and looking into the decade will become even trickier. But let's face this. The world economy will not be the same again. And the South African economy wouldn't be either. And as we think through these things, we have got to be saying to ourselves, what is actually, what used to be normal is not going to be the normality we return to. And as we deal with this shock, I know I hear people talk of a post-COVID economy, and I'm sure there will be a post-COVID economy. That post-COVID economy, I don't know how many years to come would that be. As it stands now, we have got to learn how to manage this economy in the context where we are faced with the COVID challenge. Absent a vaccine or a cure, we're going to have to live with this COVID. And we are going to be faced with this challenge. We have had these shocks. And just from this, that, it takes a couple of years for the country's economy to return back to where it was, just in terms of the level of the GDP. And I wouldn't even hasten a guess of we will be back to where we were last year. I won't even say to you in 2 years or 3 years. It's something that I do not have enough information to even hazard into. All that I know is that as we think we are striving for normal, the environment prior to COVID is not what we are going to experience as normal. There is going to be a normal, but that normal is going to be new.
And before I let you go, sorry, a quick answer here. I like hearing the different views on this. Universal basic income. Even your minister, finance minister, I was surprised when he spoke with glowing, actually appreciation for that future of a UBI for the country. Your view on universal basic income, just as we close this.
Interesting concept.
Yep.
It is a fiscal decision and not a monetary policy decision.
I'll leave you like that. Thank you so much for your time this morning. That was the Reserve Bank Governor, Lesetja Kganyago. Thank you so much.
Thank you very much. Much a pleasure talking to you.